My name is Mark Knodel. I'm a financial advisor and I lead the wealth management division of the Knodel Group. I will explain the concept behind the Value Masters portfolio. One question I often get asked is, why don't you recommend individual stocks? I've been in this business for more than a quarter century. Over that period of time, you figure out what you're good at and what you're not so good at. I believe that few individual financial advisors are really that good at picking stocks. They lack both the time and the expertise to do this very well. After my response, I usually get the follow-up. Well, if financial advisors aren't good at picking individual stocks, who is? No. I believe the best stock pickers are the managers of well-established hedge funds. The problem is the biggest and the best hedge funds are either closed to new investors or have huge minimums, precluding average investors from ever benefiting from their expertise. That's my normal response. But now I continue. However, any hedge fund manager that manages in excess of $100 million in assets must disclose his holdings to the Securities and Exchange Commission by filling out Form 13F no later than 45 days after the end of each calendar quarter. In other words, their stock picks are public information if you know where to look. The information found in 13F filings is used in a strategy we developed that we call the Value Masters portfolio. The name describes the strategy. As the portfolio is made up of 10 value stocks, and we use 17 of the very best value-style hedge fund managers, hence masters, to get a consensus upon which stocks make up the portfolio. In Warren Buffett's words, value managers put heavy weight on certainty. It's not risky to buy securities at a fraction of what they're worth. The concept behind the Value Masters portfolio is really quite simple. The strategy begins with the previous slide's 17 platinum-plated managers that have built their reputations over long periods of time. About 45 days after each quarter, each of these managers must report their portfolio holdings. The strategy is to buy the 10 most popular, widely held holdings from this group of managers. The 10 most popular holdings are determined by the number of managers that hold a security in their top 20 holdings. For example, the more managers that report a security as a holding, the more popular it is. The 10 stock holdings get popularity weighted. Each holding is weighted based on how popular the holding is amongst the group. Like in the chart on the right, a security which is held by 6 managers will have twice the weight as a security held by 3 managers. The 10 stock holdings will be held in the account until the next holdings update. The Value Masters portfolio has a hedging component that is based on the 10-month moving average of the S&P 500. The 10-month moving average is the key tool we use to help preserve client assets from big down markets, and I discuss this in more detail in my video, How We Help Preserve Assets in Down Markets. Similar to a traffic light, when U.S. stocks are trading above their 10-month moving average, they are represented in green, and when U.S. stocks slip below their 10-month moving average, they are represented in red. Let me explain why. Let's look at the bottom of the chart. In yellow, you see U.S. stocks from 1901 to 2008. This number circled in green means that for more than 100 years, U.S. stocks traded above their 10-month moving average about 70% of the time, and circled in red, 30% of the time they're traded below their 10-month moving average. When trading above their 10-month moving average, annual returns of U.S. stocks on average were up almost 14.5%. And when they were trading below their 10-month moving average, the annual return was a mere 3%. Plus, annualized volatility is a measure of risk. U.S. stocks were almost 70% more volatile when trading below their 10-month moving average and only returned 3%. In other words, when U.S. stocks are trading above their 10-month moving average, historically you get much more return with a lot less volatility. Take a look at the data of the U.S. stocks from 1973 through 2008. You'll see very similar results. With that in mind, the Value Masters portfolio hedge process works like this. As long as the S&P 500 is trading above its 10-month moving average on the close of each calendar month, the strategy will stay 100% invested in the 10 stocks in the portfolio. However, If the S&P 500 closes below its 10-month moving average at the end of any calendar month, a hedge will be implemented for the following calendar month. When the hedge signal is on, 50% of each stock holding will be sold and the proceeds will be used to hedge the portfolio. By doing this, one half of the portfolio will be invested in a fund that strives to correspond to the inverse or the opposite of the performance of the S&P 500. The hedge will remain in place until the S&P 500 moves back above its 10-month moving average at the end of a calendar month. On this occurrence, the hedge will be sold and the proceeds will be invested back into the stocks in the portfolio, returning the portfolio to 100% invested. In summary, the Value Masters portfolio is a portfolio of 10 individual stocks. Stocks are chosen from the consensus holdings of 17 of the very best value-style stock pickers in the market today, based on their Form 13F filings. Even though you may have great stock picks, there are times when the odds of making money in the market are against you. For these times, the portfolio has a hedging process designed to help preserve assets. If you would like to learn more about the Value Masters portfolio, give me a call or send me an email.